They provide a completely passive investing opportunity and cash flow. Common questions to ask a potential syndication partner are:
Welcome to Requity Insights, a channel dedicated to documenting our journey to 100 world-class communities.
Welcome back to another episode of Requity Insights. Today we're going to do a general overview of commercial real estate syndications. If you've ever wondered what they are, who's involved, and what they aim to achieve, you're in the right place. So let's get started. So what is a commercial real estate syndication? Simply put, a commercial real estate syndication is a mechanism by which like-minded investors can pool or aggregate their capital to jointly invest in real estate opportunities, usually larger-scale commercial properties. Rather than buy properties individually, these investors own fractional shares of an entity that owns the overall property. Syndicates provide investors with lots of advantages. They allow them to invest in larger properties they otherwise couldn't afford individually. They also allow them the opportunity to leverage the knowledge, expertise, and experience of real estate professionals who run and operate the properties on behalf of the investors. They provide a completely passive investing opportunity and cash flow, all while participating the investors in the tax benefits and forced appreciation that comes with owning the property. Real estate investors who participate in syndications are able to show less income than they actually bring in each year, thanks to depreciation losses. Since commercial real estate properties are physical structures that age and experience wear and tear, the IRS allows investors to write off a piece of that against any earned income. Watch our video on tax benefits of real estate syndications, linked below, to learn more about that topic. Legal structures and the players involved. Real estate syndications are generally held within legal entities. Today, the most common structures you'll encounter are limited liability companies and limited partnerships. In these legal entities, the sponsor is known as the general partner, or the GP, while investors are designated as limited partners or LPs. These legal entities provide significant asset protection, especially to the limited partners. Part of the sponsor's duty is to create that legal entity. The sponsor will also create legal documents that are important to know and understand. In commercial real estate syndications, several key players come together to make the investment opportunity a reality. First, there's the sponsor, also known as a syndicator or GP, as mentioned above, who identifies the property, conducts the underwriting, performs all the due diligence, and puts the entire deal together. They're essentially the project manager responsible for executing the proposed business plan and making the investment profitable. Next, you have the limited partners. These are the individual investors who contribute capital to the syndication. They have a passive role, which means that they don't actively manage the property, but share in the potential profits and tax benefits of owning the deal. What's the objective of a commercial real estate syndication? The primary objective of commercial real estate syndication is to create a win-win situation for all parties involved. Syndications can be an incredible vehicle to build wealth over time and create passive income along the way. That being said, the syndicator matters, and you should conduct your due diligence prior to investing. Common questions to ask a potential syndication partner are: how long have they been in the business? What is their transaction volume and assets under management? What is their track record? You want to know their best performing deal, their worst performing deal, and everything in between. Do they have happy repeat investors that fund their investment quickly, or do they have to rely on crowdfunding marketers to raise money for them? And lastly, how transparent is their reporting, and will they provide you information on their previous deals for you to review? As a passive investor in real estate syndications, you have the opportunity to invest with experts, so ensure you pick the one that fits your investment goals best. For sponsors, it's an opportunity to leverage their expertise and skills to generate substantial returns on their investment. For the limited partners, it offers access to high-quality commercial real estate assets and the potential for attractive returns without the burden of the day-to-day management. Now let's talk about the responsibilities of each party in a commercial real estate syndication. The sponsor or the GP is in charge of sourcing the deal, performing all underwriting, negotiating with the sellers, and conducting thorough due diligence. They also handle financial arrangements, which means raising capital and placing debt. They oversee or perform the property management, and they make strategic decisions to increase the property's value over time. Sponsors also handle all aspects of investor relations and tax returns, and distribute K-1s at the end of the year. For communication, sponsors generally send out monthly or quarterly reports to speak on the financial health of the property, as well as communicate any noteworthy events or CapEx projects that have occurred during the reporting period. On the other hand, limited partners provide the necessary capital, but their involvement ends there. They trust the sponsor's expertise and rely on them to execute the business plan successfully. Is commercial real estate considered a security? If you're using other people's money for your real estate transactions, you're probably selling securities. Securities include promissory notes or investment contracts between a manager or general partner and passive investors. Under the Securities Act of 1933, sales of securities must be registered unless exempt. There are numerous exemptions from registration, but by far the most common exemption has been the Rule 506 private offering exemption. Most real estate syndications are filed as 506B or 506C offerings. Rule 506B is part of the SEC's Reg D that allows you to sell securities to an unlimited number of accredited investors and up to 35 non-accredited investors without registration, so long as you can prove that you had a pre-existing relationship. Sometimes referred to as a friends and family offering, syndicators can raise an unlimited amount of money as long as they do not publicly solicit for those funds. On the other hand, 506C is only available to accredited investors and came into existence as part of the Jobs Act in 2012, offering an alternative pathway that allows for general solicitation while still providing exemptions from registration required with the SEC. With this regulatory reform in place, syndicators can now cast a wider net in their search for potential investors and develop more informative fundraising strategies. What is an accredited investor? An accredited investor is defined as a person with an annual income exceeding $200,000 or $300,000 for joint income for the last 2 years, with the expectation of earning the same or higher income in the current year, or someone who has a personal net worth exceeding $1 million, and that cannot include their personal residence. It is crucial to recognize that each rule comes with its unique set of prerequisites and obligations that must be met by issuers seeking to take advantage of these exemptions. Since these investments are governed by the Securities and Exchange Commission, that means that the investment opportunity must comply with securities regulations, and sponsors need to make sure that they issue private placement memorandums, or PPMs, and provide full disclosure of risks and potential returns to the limited partners. We'll have a separate video on common documents in real estate syndications coming soon. Syndication return structures. There are many different ways to structure real estate syndications. They could really be as simple or complex as the syndicator or GP decides for them to be. For the most part, they include a preferred return followed by a promote. A preferred return is a minimum return that the deal will have to hit in order for the sponsor to start to make any money. For example, if a project has a 7% preferred return, the first 7% of all cash flows after expenses must be returned to the investors before the GP can start participating in any profit. The promote is the percentage split above the preferred return. Common splits are 70-30 or 80-20 in favor of the limited partners, depending on the type of deal, the profitability, and the level of risk involved. What are some risks? Like any investment, nothing is risk-free. That is why it's very important to conduct thorough due diligence on the sponsors and the deals you want to participate in. How a deal is underwritten is the roadmap the syndicator intends to follow, so dig into the numbers and make sure the desired raise matches the needs of the property. A common underwriting mistake includes underfunding the CapEx budget for the value-add proposition at play. Other potential risks include the risk of default or bankruptcy, which could result in the loss of the investment property. And lastly, the possibility of fraud or mismanagement by the syndicator or other members of the syndicate. So that's why your due diligence on your GP or your syndicator is also incredibly important. There you have it. This is a simple breakdown of what a commercial real estate syndication is. It's an incredible way for individual investors to participate in large-scale commercial properties and leverage the expertise of seasoned professionals. If you enjoyed this video, don't forget to hit the like button. And don't forget to click the notification bell to stay updated on our latest updates. If you have any questions or topics you'd like us to cover in future episodes, please feel free to leave them in the comments below. Thank you for watching, and we'll see you next video.
Thanks for tuning in to another episode of Requity Insights hosted by our team at the Requity Group. You can find recordings of all shows along with our opt-in form to set up a call and view future investment offerings on our company website, therequitygroup.com, also listed in the show notes.